Hey, welcome back, everybody. Welcome back. It's Ed Ponsi here, your FX educator here on behalf of FX Street. It's great to be here. Just taking a look at dollar yen here, taking a big stair step down on the 5-minute chart and moving lower and lower. This is the lowest we've seen dollar yen in quite a while. Take a look at the damage here. Um, this is just on the 5-minute. I'm going to back it up here. Let's go to the daily first. We should always start with the higher time frame and work our way down. You caught me here on the shorter time frame. Take a look here. Dollar yen sneaking past support here, breaking support with a big red candle today and reaching its lowest point of the year. This is the lowest that dollar yen has been since November of last year. How about that, folks? The lowest point since November of last year, so about 10 months since the last time we've seen dollar yen this low. And usually that means that stocks are down. And as I go to the S&P futures at ES, because that's a correlation, right? You can see a red candle on the S&P futures. So there's a correlation there. But really, dollar yen has been falling for quite a while. And so it's more than just the stock market. There's a lot of bad news. There's a saying that the yen loves misery, and there's plenty of that. So a big red candle today. Can we just name some of the things that have been happening today? We have an earthquake in Mexico, right? A big one off the coast of Mexico. 8.0 or an 8.4 or somewhere in between, depending on who, very often it takes time before we can determine the actual final tally on that earthquake, but it's in the 8 range. That's a very bad earthquake, and it's offshore, so there could be a tsunami to follow. So that there's one thing, and of course then there's the never-ending drama with North Korea and the United States, and there are numerous issues ongoing. There's the hurricane bearing down on the Caribbean, heading toward Florida and the United States. All of these things, together, just, bad news all around. You got an earthquake, you got a hurricane, and it's just a lot of bad things going on all at once. So, yeah, magnitude 8 earthquake struck off the Pacific coast of Mexico. The one thing I think people worry about with these earthquakes is that very often you get one, and then you get another one, and then you get another one, and you just worry that maybe there's going to be more to it, right? So anyway, really bad looking chart there, unless you're short, of course. That's a huge break. And so how do we play that? Well, there's a number of ways to play it. The classic way, right, is like this. You see that line? That line that we just drew there is approximately 108, correct? This support level is broken, so support becomes resistance. So this is a very simple concept. Howdy, Brendan. Didn't see you there. How's it going? So a rally to 108 or in the direction of 108 would be an opportunity to sell. You would want to sell strength. What could cause strength? Well, any number of things, right? Yesterday, we had sudden dollar strength intraday. Didn't last, but it did happen, right? It did occur. And if I go to the intraday chart, maybe we can locate it, right? So all of a sudden, the dollar became strong intraday. It happens all the time, right? What can happen? Well, like for example, what if a member of the Fed started to say things that were hawkish, for example, right? What's hawkish? Hawkish means we're going to raise interest rates. What if a member of the Fed started to say hawkish things? Well, that actually happened last night. And when you say hawkish things, the dollar gets stronger. And so you see these little rallies. If somebody from the Fed makes a hawkish statement, the dollar should rally, and then you should sell that rally. What did Dudley say, by the way? So these are the things you need to listen for. Dudley said he expects U.S. policy to continue tightening, meaning raising interest rates, continue tightening gradually. But he does not repeat expectation for a rate hike this year. Well, so he's not all that hawkish, I suppose. But then again, this year's coming toward its end. Dudley also said that hurricanes could create more inflation. Anyway, so forget about Dudley for a moment. What else could we use? It doesn't have to be dollar yet. The dollar's been really weak and the yen's been really strong because, like I said, the yen loves misery. And we've just got a line of hurricanes out there, and we've got earthquakes, and we've got, problems with North Korea, and so the yen loves this kind of stuff. The yen does well in this type of environment. Remember, I don't know if you remember last week we talked about this currency pair, NZDJPY, New Zealand Japanese yen. I'll show it to you on the daily first, right? On the daily, we said, hey, double tops and lots of resistance and bearish trend lines, right? But particularly lots of resistance in this area here. We should be selling short, right? And in addition to that, right, we should be selling short because of this trend line. So it pops up, go to the 60. Well, look at that. Right? How nice is that? And now, right, price has dropped significantly from that trend line, which is beautiful, right? So that's fantastic, and it's great the way that things are working out for people who are buying yen. Now, the one group we haven't heard from yet is the Bank of Japan. We did hear some statistics out of Japan last night. But we haven't heard anything from the Bank of Japan yet. Why do I care about the Bank of Japan? Because if the yen keeps getting stronger, isn't it true that the Bank of Japan theoretically could try to do something about that, right? They don't like it when the yen gets stronger and stronger, do they? They dislike it rather actively, and they could do something about it. So Japan last night, GDP, GDP deflator. GDP came in actually a little bit light for the second quarter, just 0.1%. GDP deflator, that's an inflation figure, negative 0.4, that's in line with inflation. And annualized GDP came in light as well. And yet the currency gets stronger because why? Because the yen loves misery. I've been telling you that for a half hour now. Okay, so even though some of these figures are not positive, the yen gets stronger anyway. Why? You say it. The yen loves misery. Okay, so even when they had the tsunami, the yen got stronger. You remember that? That was like in 2011. The yen got stronger, right? Why? Well, you know the answer. All right, so anyway, so all that data last night, but the Bank of Japan has been quiet so far. But I want you to consider something, right? So when I'm going to show you this on a longer term chart, the Bank of Japan hates this, right? They hate it to see dollar yen go from 110 to 107. And they hate to see it go from 114 to 107. And I'm going to show it to you on a weekly chart to make it even more clear why. But it's a pretty wide span of activity, right? So imagine this. Imagine that Toyota makes $1,000 profit, 1,000 US dollars profit for every car they sell in the US. So regardless of how much money you pay, they make $1,000 profit. When $1 is worth 125 yen, $1,000 is worth 125,000 yen. When $1 is worth 80 yen, then that same $1,000 is worth 80,000 yen. So the profit on the car doesn't change. Toyota makes $1,000 profit on the car, no matter where dollar yen is. When dollar yen is down here, they make $1,000 profit. When dollar yen is up here, they make $1,000 profit. The problem is, from their perspective, that when the chart is down here, the $1,000 is only worth 80,000 yen. And when the chart is up here, the 1,000 US dollars is worth $125,000 yen. You see the difference? It's a huge difference from Toyota's perspective. And that's why Bank of Japan doesn't want this chart to go down. The last time we heard from Bank of Japan, right, was when this down here last year when we got to 110. That's when Bank of Japan started to make a lot of noise about we're going to push it up. And Bank of Japan will push it up. Now, I will never short this when Bank of Japan is talking about pushing it up. And when I say pushing it up, pushing dollar yen higher is what I'm talking about. But Bank of Japan is not currently discussing intervention. They're not. There's a series of magic words, right? that they throw around, and they sound very innocent, right? They'll say things like, "We are watching exchange rates closely," but they're not saying these things, right? That's how they start. It sounds innocent, and then it gets less and less innocent. But they're just not throwing it out there yet. So we're free to short, is what I'm saying. We're free to short. I'm shorting this at 108. Now, Carlos says, why don't we buy it at 104, 105? It depends how quickly it gets there. And this, understanding this is a long way toward understanding how the Bank of Japan thinks. You see, Bank of Japan could intervene at 104 or 105, which would make this a brilliant trade, idea for Carlos, regardless of what the chart says. It would depend how quickly the price got there. Speed. Speed plays into this. Why? Why does the Bank of Japan care how quickly the price gets to 105? It's because hedging strategies very often use futures contracts and options contracts. And futures contracts and options contracts expire. So when Toyota, and I like to use Toyota as an example because it's an obvious example, but it could be any company. And it could be Sony, and it could be Canon copiers, and it could be Honda, and it could be, any of hundreds of different Japanese companies, right? They're using options, and they're using other contracts that have a limited life shelf. You see, hedging costs money. And so Toyota has purchased options, and they've protected themselves against a reasonable move. But they have not protected themselves against any move that could happen. They've only protected themselves against a likely move. So if a completely unreasonable move occurs, like if we get a red candle tomorrow that goes all the way down to 100, or not even 100, if we get a red candle tomorrow that goes all the way down to 104, I would say Bank of Japan is almost guaranteed to intervene, because there's no way that every company is hedged for that type of lightning fast move. They're only hedged for moves that are likely to happen, because in order to hedge for every possible contingency, it would be incredibly expensive to do that. It would not be cost effective to hedge for every possible move. It would cost too much money to do that. So as long as the price gets to 105 at a reasonable speed, then Toyota has time to roll out their hedges and roll out to the next expiration month. And you understand what I'm saying? They have time to adjust their hedges, as long as it happens at a reasonable speed. If things happen too quickly, and a lot of the time when you hear the language that comes out of the Bank of Japan, a lot of it has to do with volatility of the market. If the market becomes too volatile, we might get involved. Those are the type of things they say. That's what they're talking about. They don't care if it gets volatile going this way. They don't care if dollar yen gets volatile heading up, but they care a lot if it gets volatile heading down. They don't care if it moves up quickly, but they care a lot if it moves down quickly. Because if it moves down quickly, then Toyota might not be completely hedged. Sony might not be completely hedged, right? So just some food for thought there. technically speaking, I look at this as your election candle, right? Because all the election candles look the same. The markets all went one way and then went the other way because everyone thought the election was going to go one way and then went the other way. Isn't that true? So you look at the candle of just about everything, looks like this. It all went one way and then the other way. So if you throw a line in at around 104.50 or 105, this is 104.50 right here, within a few pips, right? Okay, thank you, Brendan. Appreciate that. So I've been living with these interventions since 2003, and trading these interventions since 2003, and I've been watching what happens to people who get caught on the wrong side of them since 2003, and believe me, it's not pretty, right? It can be really ugly, and so, but the Bank of Japan will give you plenty of time and plenty of warning. This is the wonderful thing about them, is they will give you plenty of opportunity to stand out of the way and to get out of their way, and they're gonna tell you repeatedly what they're going to do before they do it. In so many words. Right? In so many words. Now, on this chart, I don't really see, because of the way this candle is shaped, I don't really see it. I guess I don't really see what you're seeing, Carlos. That doesn't mean you're wrong. It just means I don't see what you're seeing. So just take my words at face value there. Because, but if I went to a different time frame, I might see it. But it's like a little dance they do in Japan. It starts out so innocently. They'll say, we are watching exchange rates closely. And you'll think, well, that sounds so benign. You know, how could anybody possibly derive any meaning from that? But the truth is, when they're saying we are watching exchange rates closely, they're suggesting that, you know, we're watching them closely and we might do something. We might move them in a direction that favors our companies and our stock market. Then later on, they might say something like, exchange rates should reflect fundamentals. And you're thinking to yourself, well, that sounds like economics 101. You know, it doesn't sound very earth-shattering. But what they're really saying is, we don't believe that the current exchange rate reflects fundamentals, and we will move the exchange rate so that it reflects our view of fundamentals. That's what they're really saying. So it all sounds very, very innocent until they start pushing the market. Right, but you'll get plenty of warning, because they're saying these things to the Wall Street Journal, and they're saying it to Bloomberg, and it'll be widely reported on CNBC and Bloomberg, because everybody in the business understands what it means. And, you know, it'll be impossible to escape these comments. And now usually when they start making these comments, the price will jump up, because shorts will say, uh-oh, you know, if I'm short dollar yen, they're threatening to push dollar yen up. I'm going to say, well, I'm not going to be short if the Bank of Japan is going to push this up. I do not want to be on the other side of the trade. And so the shorts begin to cover and the price moves up. And so Bank of Japan, without spending a dime, just by making these comments, can create the desired effect. But if the price does not continue to move their favor, if it does not continue to have the desired effect, they might actually have to take action. And back here, They never did take action back here. They were talking. They started to talk their game back here, and talking had the desired effect. And then came the election, and the election took care of the rest. The election pushed dollar yen from 100 up to almost 120. And now the dollar is sinking back down. The euro has a lot of momentum. I don't know if you missed it yesterday, but Draghi laid out some pretty fairly bullish stuff yesterday for Europe. Actually raised GDP expectations for this year for Europe. And then you've got countries like Canada raising rates twice in 2 months. You know, things are looking better. You've got gold and copper going through the roof, which means business must be good in Australia and China. So stuff is percolating out there around the world. All right, and that can't be bad for Ed. It can't be bad for us, right? Here in the U.S. All right, so we've raised rates here in the U.S. We may get one more in this year or next year, one more rate hike. All right, so it's not bad. Can't be bad news, right? All right, so the other currencies are now beginning to raise interest rates, and the dollar's coming down. People are down on the dollar now. But just don't forget the dollar had this amazing run, okay? Everyone forgets that the dollar had this incredible run. You're saying, oh, the dollar's so weak. Yeah, but look what the dollar did prior. Don't forget where we came from. There were zero rate increases here. This was all in anticipation of rate increases, okay? This was all anticipation. And now that we're getting rate increases, dollar's coming back down. Why? Because other countries are now increasing rates too. So where's the advantage for the dollar? You think the dollar's, the U.S. is not the only country raising interest rates out there. Okay. So anyway, you've got to go with the trend. That's the way it works in Forex. I don't believe in fighting this unless it gets stretched too far, right? Unless we stretch too far. Right now, euro yen, nice trend, right? Lovely 10-day moving average support. It's coming in back toward the 10-day. Pound yen, not so much. Weakling against weakling here. No real trend. But euro yen seems to be running up the 10. And that looks like it might be good for a pickup if that drops a little bit lower. But really, it's all about the yen right now. And that's the one I think you need to keep an eye on here. Okay, what about the strength of the CAD? Canadian dollar. Well, you raised interest rates this week. Look at that, and that's today. Holy cow, right? That's the weekly, right? So they raised interest rates this week. They raised interest rates twice in 2 months. And just to sum up Canadian dollar in a nutshell, I think it's going back to 120 against US. There's your big support. You see that line I drew at 120? That's where I think it's going. You see how it's getting closer and closer? Look at that. I think that's where it's going. 120. Why? Copper and gold and other metals are through the roof. And, Canada is a pretty big producer of all of those things. Oil isn't really going anywhere, but and Canada's a big oil producer. But it's not going down, right? It's not going up, but it's not going down. It's just kind of stuck in this sideways mode. It's been stuck sideways for like a year now. Oil's been trading. Look at this. Look how oil's been sideways since the beginning of 2016, right? It's just been going sideways. And so it's not helping, but it's not hurting. But other commodities are just going up, right? That's copper. Look at that. Big red one today on the weekly, but look at the way it's been going since October. It's up from $2.10 a pound to $3.10 a pound. That's a huge move. Look at gold. Gold's gone from at the beginning of this year it was $11.50. Now it's $13.50. Big move. This is rocking in Canada. This is rocking Canada right now. Yeah. Oh yeah, says Brendan. So there's a lot to like here, right? There's a lot to like about Canada. But I'll tell you one more thing. And this tells you there's got to be something good going on in the U.S. because 3/4 of Canada's exports go to the U.S. So it can't all be, there must be something good happening in the U.S. too, right? Because Canadian exports have been doing well, and 3/4 of Canada's exports go to the U.S. On that note, folks, I'm going to end this session, but I'll be back at the top of the hour with another session. So please come on back. If you enjoyed it, tell a friend. We have a good time. We get into some good stuff here. So I'll see you back here in less than 30 minutes. This is Ed Ponsi for FX Street. Thanks for listening.